Hi, I'm Justice Lee. Welcome back to Finance with Lee. Today we're going to talk about whether you should really have an emergency fund. Now, there's a couple of schools of thought out there. First is people like Dave Ramsey. They'll tell you should absolutely have an emergency fund. It should be huge and it should be all cash. There's another school of thought that says you should not have any emergency fund because cash is trash. If you have cash, you're losing money, and if you have an emergency, you should use credit cards and lines of credit to hold you over until you can pay off the debt. And before I get into my opinion, we'll take a look at some pros and cons. So, pros of having an emergency fund. Obviously, you can actually meet your obligations if you have an emergency or a job loss. This is really important. You have cash to meet all your obligations. You don't have to sell stocks because obviously selling your investment really sucks. It gives you peace of mind. Personally, my wife doesn't like to not have an emergency fund. I don't think she would be able to sleep well at night. So even if I'm losing a little bit of money, it's worth it to have her know that we're covered in the event of an emergency. Also, you can help others out. I think the more money that you get, the more you realize that it's great to be able to help other people out. If you're good with money, you almost certainly know other people who are not good with money. But does that mean you should not help them? Of course not. You should absolutely help them out because not everybody is great with money. That doesn't mean that they're bad people. And I find that it's really fulfilling to be able to be good with money and to help other people out when they need it. So let's get to some of the cons. So obviously inflation is one of the big ones. Anybody who says an emergency fund is a waste of time, usually one of the first places they go is by saying you're losing money to inflation. Every minute or every day that you hold that money and it's not invested, inflation is just deteriorating the value of that money. Every day that you hold that money not invested deteriorates the value of that money. That's absolutely true. There's also an opportunity cost associated with it. So if you think about it, if you have $1,000 and it's not invested, not only is it losing money, that 3%, but it's also losing money because it could be invested in stocks or another investment. So if you consider that stocks go up by about 7% a year, if you account for inflation and the fact that you're not doing the most you can with that money, it's actually going to cost you more like 10%. Or you can insert your own number. If you have higher yielding investments, you can insert another number instead of 10%. But you're obviously going to be losing a lot of money by doing this. So this is one of the major detractors why people don't like to get an emergency fund. 10% a year is a hard hit to take. You'll lose your money very, very quickly by doing that. Our last economic crisis was back in 2008, 2009, and I'm sure there have been a lot of people who haven't used their emergency fund like since then. Another thing is, since our last economic crisis, or maybe even before that, there have probably been a lot of people who haven't really had a substantial emergency where they needed their emergency fund. And in that case, I'm sure they've looked at that thing and they've said, wow, this entire time I could have tripled or quadrupled my money if I would have invested it, and I haven't even needed this emergency fund, so what a waste. But what do I think? I think you should definitely have an emergency fund, and the reason is because you don't want to have to sell your stocks. You don't want to have to be in a situation where you are having to sell things that are worth a lot less than they were before because you lost your job and you're going to be hurting really bad. So I just told you I do believe that you should have an emergency fund, but you're saying, well, why not that credit card or that loans idea? I think this is an absolutely terrible idea because the banks can cancel your credit cards. They can cancel your credit lines. They can decrease your limits significantly. And if you read the terms, that's absolutely something that they can do with no notice. And if you think, oh, there's no way they would do that, I have a really good credit score, I'm a good borrower. That's what was happening in 2008, 2009. When they believe that there might be a substantial risk, even if your credit's great, they can just completely cut your line down to nothing so that you're not tempted to go out and pay your mortgage and try to do all kinds of crazy things with this money and then never pay them back. Since those types of things usually aren't secured, they're going to freeze them or eliminate them completely. And in 2008, things that people tend to think are really stable, like a home equity line of credit, they were completely canceling those too because the value of property started to go way down. So if you had a home equity line of credit because you owed 250 on your house and it was worth 350, but then you had a home equity line of credit that would have used up that difference between about $300 and $250,000. But if your house went down in value to 250, now you owe just as much on your house as it's worth, and there is no home equity. So they just canceled your home equity line of credit. So I personally use a tiered approach. Some people believe all cash, and I can kind of understand that, but I don't think that you're getting everything out of it. I think you should do something with your money to help you hedge from inflation. So I have 3 tiers. So I think a 6-month emergency fund is appropriate. I usually do the first month in a high yield FDIC insured savings account. So there are places like Ally Bank. I'm not sponsored by them. Obviously, I only have like 20 subscribers, so obviously I'm not sponsored, but they will pay you a pretty decent rate. It used to be around 2%, I believe, and now it's a lot lower because of the current economic climate, but it's usually around 2% or maybe 1.5%. So you're not going to be keeping up with inflation with this account, but the good thing is it's going to be easily accessible. So the tier 2, I usually have that at about 2 months. So 2 months worth of your expenses should be in ultra short term US government treasury bond ETF. So what these are is these are obviously treasury bonds that are issued by the United States government. So the FDIC, which insures your bank account, is the Federal Deposit Insurance Company or corporation. I can't remember what exactly it stands for, but they basically say the United States government is going to guarantee your money in this account up to a certain amount. U.S. government treasury bonds are similar in that they are also backed by the full faith and credit of the United States government. So even though one isn't technically insured by the FDIC, they're backed by the same entity, and so they're very safe. They're also very liquid. These bonds, when they're in ETF form, can be easily bought and sold. They also don't tend to lose their value. So even if the stock market's getting absolutely hammered, usually these bonds will stay the same or even go up in value. There are some situations where you can lose money in them, and so that's why I don't think you should invest all of your money in them. But in my lifetime, I don't think there's ever been a period of time where these kind of ETFs or these kinds of bonds actually lose a significant amount of value. So the reason I choose ultra short term is because if interest rates go up, these really short term bonds can lose value. But if your ETF is constantly buying new ones to replace the old ones that are maturing, then you can keep up with the most recent interest rates. So my tier 3, which is 3 months worth, is in investment grade corporate bond ETFs. So they will pay you more interest than either of the first two, but they're also a little bit more risky. So these, even in a very terrible market, don't tend to go down too much, and when they do go down, they tend to come right back. And that's the reason why you have 3 months worth of this. These usually do beat inflation. The tier 1 usually won't beat inflation. Tier 2 will be approximately what inflation is. Sometimes it'll beat inflation. But the tier 3 generally will beat inflation with the investment grade corporate bond ETF. What this does is it invests in some of the best companies in the United States with great credit ratings. So we're looking at companies like Apple, Google, Microsoft, companies that really have strong balance sheets. Their bonds don't pay super high yields, but they're extremely safe. So this is what I like to keep at the tier 3. So in order to need to use all this money, you would have to be in a serious situation where you lost your job, and so you would have a whole month to think about taking out your tier 2. So if they're temporarily down, you'll have a little while to wait out. And then same with your tier 3, you'll have the whole 3 months to consider taking your tier 3s out. And usually if these tier 3 ones are down, it's usually for a very short period of time. So that's why I like these 3. And the percentages, they're going to vary with the economic climate. So I'm not going to give you percentages that you're normally going to get for these 3, but I will say the first tier usually does not beat inflation, but you get something. Second tier usually is similar to inflation, and the third tier usually does beat inflation, but you're also taking more and more risk with each tier up. That being said, all three of these investments are very safe and have little risk of losing all of their value. Now, I'm not going to sit here and tell you there's no risk whatsoever, but I think if you're looking to try and preserve some of your capital as well as having a very safe emergency fund, this would be a great approach to use, and this is exactly how I save my money for short term. So when we're talking about how big it should be, I recommend 6 months of expenses, and that's just because if you lose your job and you're looking for something new, it may take you a while before you get a new job, or if the economy is in really bad shape, jobs may just not be available for a while. So 3 months I think is just too short, and that's what a lot of people recommend, but I just don't think it's long enough. And if you go over 6 months, I really do think that you're shooting yourself in the foot when it comes to investing. If you have a year's worth of money saved up and you're never going to use it, I don't think that it's a smart idea to have that much money saved and not doing anything for you. Obviously, the more wealth you have, the bigger your emergency fund should be, but the more different investments you'll have available to you in the medium to low risk category. So the more money total you have, the more you can hedge yourself and hedge your investments and diversify so that your assets are less likely to lose value even in a bad economy. Real estate should have its own considerations for each property. Each property should be almost its own person. So if you have 6 months of expenses saved for yourself in an emergency fund, so, so, so should each property that you own. The reason for that is if you have a significant problem with one of your pieces of real estate, you don't want that to interfere with your personal emergency fund, because what can happen is if you have something really bad happen to that real estate property and you deplete your emergency fund, you may not have enough time to rebuild your personal emergency fund, and then if you lose your job or something, then you're going to be in really big trouble. I also consider having that first month being easily accessible, but not too accessible. So if you have a high yield savings account, I would recommend not having any type of a card where you can just take money out immediately. I would have that account linked to your normal checking account and then just do an ACH transfer if you need the money, because it's going to take 2 or 3 days. In that case, you'll be less likely to just use a little bit of it when you're a little short 1 month. It'll actually be a decision that you need to make. You have to wait several days to get the money out. The harder it is to get, the less likely you are to spend it. I'll just add as a side note, when we're talking about the accessibility of the money, there is research that shows that if the money's in your checking account, you're almost 100% likely to spend it. However, if the money's in an investment account, you're almost not likely at all to spend it. You're almost 0% likely to spend it. So just the money being in a checking account where you're mentally programmed to spend that money versus an investment account where you're mentally programmed to save that money makes a huge difference. So consider, if you have the discipline not to buy stocks when you see a really good deal with that emergency fund money, putting that money in your investment account instead of any checking or savings account, that may also be a better bet, because you're very, very, very unlikely to spend that money if it's actually in a brokerage account. So just as a reminder, here are some important reasons why you probably should have an emergency fund, right? You don't want to lose your house. You want to be able to pay that mortgage if something bad happens. You don't want to ruin your credit score if you can't pay some of your bills off. You don't want to sell any of your investments at a loss if the market's also down. So for me, these three reasons are very, very important, and they're worth taking a hit when it comes to not making as much by investing the money, because it only takes one time of a really serious emergency to really cost me a lot of money. But if I have that emergency fund, I know I'm set, and whenever I need it, I'm going to have it. I can also be more confident with my investing because I know, worst case scenario, if I get laid off or something like that and my investments are doing poorly, I'm I'm still fine. So I can take risk. I can do things in my investment account that may not pan out immediately. I can play the long game because I'm not going to have to pull that money out anytime soon. So what do you think? Do you save more? Do you save less? Do you disagree with anything I said? Do you think that this tiered approach is a good strategy? I've been using it. I think it's great because it usually beats inflation by a little bit, and so my emergency fund grows with inflation and I never have to add anything to it. So to me, it's just a perfect way to make sure that I don't lose money to inflation, but I have the money I need. I appreciate you coming back every week to watch my videos. I'm going to be coming out with more shortly, and have a great day.